I'll just tell your audience, so whoever is out there that is not taking in at least 10% of net income, we'll just talk about net income, bottom line net income. You don't have enough money to grow. So you're going to be cash poor all the time. So I don't want to scare you, but like you're not going to have enough cash to grow your business.
If you're an emerging franchise founder, you already know this. The jump from 10 to 100 units is where most brands stall out. Not because the concept isn't strong, but because the founder is drowning in chaos. I'm Guy Coffey, franchisor, franchisee, and growth strategist. I've been where you are, and I know what it takes to build a brand that scales without burning out, selling out, or losing control. That's why I created the Franchise Scale-Up Show. Every week, I'll share the playbooks, the red flags, and the mindset shifts that separate the brands that stall from the ones that scale. So if you're serious about protecting your vision and multiplying your brand, hit subscribe right now. This is the Franchise Scale-Up Show. I'm Guy Coffey. Let's get to work. Hello, and welcome back to another episode of the Franchise Scale-Up Show with me, Guy Coffey. And today I have a special guest, Holli Moeini. Holli is a CFO, an M&A advisor, and a financial partner to entrepreneurs that are either scaling, exiting, want to exit sometime soon. She previously served as an executive VP and CFO of a $150 million company where she had some big impact there. She led a financial transformation that reduced selling, general, and administrative expenses from 22% down to 10% of revenue. That's a big deal in a $150 million company, and helped drive a historic surge in stock price. So she knows of what she's speaking today. So that is for sure. So welcome to the show, Holli.
Thank you so much for having me. I'm so happy to be here today. Thank you.
Yeah. Well, we're going to dive right into this.
Yes.
And the theme of this show for everybody that's listening, and I'm sure it's going to resonate, is enterprise value, basically. And sometimes we think that driving revenue is driving enterprise value, and there's some distinctions there that doesn't make that necessarily true. So let's just start there. What's the difference between growing revenue and growing enterprise value in a company?
Yeah. So let me just say right off the bat we don't care about revenue. I mean, right? I want to shock you. We're going to start out with a shocking thing is I actually don't care about revenue. I care more about earnings. And so when you look at enterprise value, most value, at least right now, is valued on a multiple of earnings, right? And so it's not a multiple of revenue. Even like in the olden days, accounting firms used to be a multiple of revenue. Other industries were a multiple of revenue. But depending on what the industry is, about 70, 80% our enterprise value is created through earnings. And so I wanted to be, not controversial, but I wanted to come out with a bang saying, I really don't care about revenue. So if you think about, if you're a $50 million company earning 10%, which is $5 million, right? Is that as good as a $20 million company making 25%, which is $5 million? So if I'm a buyer and I look at a $20 million company making 25%, I'm like, I could scale that up to $50 million. And instead of $5 million, I'm making $12.5 million. So you really revenue is important. So I don't want to say that it's not important at all. But when I look at budgeting, when I look at a business, and when we look at every year on year, what are we trying to grow? We have a revenue target, and our other target is an earnings target. And I'm going to talk about an EBITDA target, an earnings target. And that I want that earnings target growing faster than my revenue. So that should be the goal. And, earnings is earnings before interest, taxes, depreciation, amortization. So you have to think about earnings in terms of how a buyer would look at you, which is they're not going to take on your interest, your debt, or they're not going to take on your depreciation or amortization. So you get to, and taxes, it's your tax structure. So you get to take that out. So it makes a complicated definition, just like take all that stuff out and look at your earnings. So even your financial statements should show that line on your financial statements every month.
Yeah.
How's that for
Let me
starting?
I love it.
I
I
know.
don't care. I don't care about
I don't care
revenue.
about revenue.
I think you caught everybody's
I mean,
attention there.
honestly, I do, but I do less. Hmm.
Right, right. So let me ask you this, just for vocabulary and terminology. When you say earnings, I think of in my world, because I've never been publicly traded. So, or I always think of EBITDA or sometimes sellers discretionary earnings, which is, in smaller businesses where there's
Yeah.
an opportunity for owners to run some things through the business. Is EBITDA and earnings kind of similar, but one's public and one's private?
Yeah, I'm just using them synonymously. And then
Okay,
sellers discretionary earnings, those are for small sellers, sometimes are traded on SDE calculation. And typically those are more lifestyle businesses, meaning you're an owner operator, right? So that's typically what a SDE, but most players, private equity, you had an episode on private equity, everything is really traded on an earnings of EBITDA or a multiple of EBITDA, sorry. So yeah,
sure,
that's what we're
sure.
looking for. So that's what we want to grow. That's what we want to focus on.
Yeah. Do you find in your practice that I'm saying this because if you worked with me, you would have found this with me, is there's such a focus on top line revenue when you're emerging, when you're growing. It just becomes the one KPI that you keep on looking at. But how does a founder go from looking at that all the time? What's the other? I know the answer is earnings, but how do you distinguish between that and what really matters? Because I'll just say from my perspective to actually ask this question in
Yeah.
a more brief form is when we're emerging, we're focused on in franchising, we're focused on units, we're focused on total system revenue that drives our royalty number. At what point is it like, hey, yes, you can always grow and that will usually not be a bad thing for you, but these are the other things that you should start looking at earlier. And I know one of the things is the SG&A expense, right?
It is. And I want to go before we go into SG&A, I don't want to not go there, but I don't want to scare anybody, but like growth is important. So if I was your CFO, I would have said, we got to grow earnings. So that's great. Let's grow the top line. And I was always incentivized to grow the top line and earnings. And so
Hmm.
I'll just tell your audience, so whoever is out there that is not taking in at least 10% of net income. We'll just talk about net income, bottom line net income. You don't have enough money to grow. So you're going to be cash poor all the time. So I don't want to scare you, but like you're not going to have enough cash to grow your business. So it's mission critical for everybody to go in, dial up their unit level economics, dial up their SG&A, make sure they're delivering at least 10% bottom line so they have that cash to grow. To grow takes working capital usually. That's what it takes to grow your company. So I don't want you running out of cash and yet everything looks gloriously, and that is what happens. So that's an important thing. So yes, we were going to talk about SG&A then.
Yeah.
Yeah.
So
So,
in your example, what you've done at that company,
yes.
driving it from 22% to 10%, like was
Yeah.
there like an 80/20 thing going on there? You found one big thing that took care of a lot, or was it like
No, no,
a little
no.
here, a little
It's
here, a little here? Yeah.
It's exactly like that. It's a little here, a little here, a little here, and then they add up fast. And that is how you do it. Now, every year, I think there should be initiative to relook at your SG&A and figure out how to reduce it. So oftentimes we don't even look at our subscriptions. Now there's AI that we can use to help reduce the SG&A even more. But I think what happens when you're growing and scaling, you may have felt this before in your life as well, when you're going from 1 million to 5 million or that upwards trend, what happens is we tend to throw money in SG&A too soon. So meaning like, oh my gosh, I got to get all these marketing people and accounting is complaining they can't get our reports done. And so we throw humans at it. And I think that if our audience can take a look at their SG&A and depending on what business you have, I'm going to pull S out. S is the sales for everybody who's on line, and you probably already know that. But we can pull that out because some industries require more in the S, particularly if you're B2C, that requires a higher S. So I don't want to distort your SG&A. And in order to grow both earnings and revenue, we want that S to be out there. So let's just look at the G&A portion of the program. Okay, so
Okay.
that's the thing that should not scale as fast as your revenue. That should be more a fixed cost, right? And that should be in a range of about not over 15%, 12 to 15%. And franchises have a marketing charge they have to pay, right? They have their own royalty charge. So they have their own set numbers there. I'm not going to include those numbers in what I'm talking about, right? So
Okay.
franchisees have to be even more efficient. So when we look at that pot of money, and let's say you're at 15% and you think you need to hire more people, it's almost like you need to earn that to hire. You need to earn more percent to be able to hire. Like you get to earn it in every way. And so whatever that means, bonus programs, whatever that looks like, you should be earning it by delivering a higher top line, and not just eroding your margins. And from what I've seen in my past, because I've grown a few companies where 30 million to 200 million, and you get to these points where you have to throw some SG&A in there, and maybe you're a little upside down, but you grow out of it. And so their SG&A shouldn't be like a linear line going up. It should be a rolling hill and then down for a while and then go up. So it really should look, it should not look linear. And if it does, you're throwing, it's usually people, okay, or things on top of in your environment that you can probably become more efficient on. So when I took, it was out of control, our SG&A, when I took over that, and it took me a couple years to do, I did everything. I mean, I looked at rent. I said, well, the leases aren't due yet. I'm going to go back and renegotiate every single one. Like I did everything under the sun and uncovered every rock because it was enterprise value, and we were trying to improve our enterprise value at the time. And we sure did it. But I do think it's a concerted effort to look at it every year and have goals around it.
And have it as a focus, because
Yeah.
I think the assumption is that it's just going to keep on going up as you get bigger. Franchising is a little bit different just because
Mhm.
it's a highly leveraged model as the
Yeah.
franchisor, because you can have a pretty small team and a good tech stack, and you
Yeah.
can support a lot of franchisees in that.
Yeah.
And
That's a very desirable business. Yes. Yeah.
yeah,
Hmm.
yeah, right.
Hmm.
It's
Yeah,
one of
it
the reasons
is.
we love it.
Yes.
So from enterprise value, and pretty much speaking to founders and leaders on that, to be clear, like look at the SG&A and see if there's ways that you can cut it down just a little bit all the time. Spend some time focusing on it, whether you're small right now or bigger. It's probably even more important when you're growing, because you tend to throw money at things, and
Yeah.
maybe there's tech that you're adding on that is redundant with something else, and if you look at it, you might find that, right?
This is a quick break to thank you for listening. Every week, we are getting more and more people listening to the show, and this growth is helping me to improve it and make it even more helpful to you. My intention for this show is to help more people win in business and life. To that end, I have a favor to ask. If you know of an entrepreneur that would benefit, please hit the share button and shoot them a text with the link. Back to the show. Make this a great day.
But let's
Yeah.
put our how you help buyers hat on for a moment. When someone's looking at an enterprise to purchase, acquire, when you're helping them look at it, what are a couple of the things that you look at that signal, that immediately give you a sense? Because you've been at this a while, I'm sure. Like as soon as you look at something like a SIM, this is a strong company. What would those parameters be, whether it's financial or non-financial?
Yeah, yeah. So I love that question because a sim is just a marketing. Okay, so buyers, that's just marketing. And so I think that the best buyers are the most disciplined buyers. So discipline is will always rule the day. What I see with buyers is that they get excited and they see the sim, they might see a P&L and go, "This is great." and they rush to an LOI, a letter of intent, which is non-binding, but it starts trading expectations and trust. Okay, so even though it's not binding, people get angry if you start retrading things later on. So
Mm.
you want to be really sure before you get to an LOI. And you can't be really sure because after the LOI is when the real due diligence sets in, right? And most deals crash out in diligence. And so if we backtrack that track, then our buyers need to be disciplined. And so when they get a SIM, they should ask for the information. And some brokers are not very good at giving you information. I've had brokers where they would not give me a balance sheet. And it was for an accounting firm. And I was like, you gave me a 9-month-old P&L, no balance sheet, one P&L, and we were supposed to put a LOI together. And then it was a broker. He's like, well, you guys can't bid. And he knew we were educated buyers. So there are people preying on buyers right now. And so you have to be careful. So get the information. I always look at 3 years of P&L, 3 years of balance sheet. And for my folks in the audience that don't look at their balance sheet, that is one of the critical documents, because if your balance sheet is wrong, your P&L is wrong. And in diligence, they find that. So a lot of deals actually go haywire. You've probably seen that. Or you get an EBITDA haircut because the problems on the balance sheet are usually reductions in earnings, EBITDA. It's usually reduction. It's usually not you're missing some revenue. We got to plump that on we got to pump up your earnings. Now, I will say, and I just want to plant this in here because I know we don't have much time together, is that all of your founders and owners and operators should make sure they're deploying proper accounting. And I know we're talking about buyers, but like I'm segueing into that because as a buyer, if you see you see a really good target after you see their financials and you like them and they're on cash basis, if they're growing, you just got millions, potentially millions after you closed because you're just going to switch them to accrual basis. So buyers, you can capitalize on that. And private equity does every day of the week. And when you talk about some of the systems that you have and AI and in accounting, you write off all these expenses. Well, a lot of those expenses can go on the balance sheet and be amortized. And so they'll never go against your EBITDA. So you better have proper accounting. Now, as a buyer, you can capitalize on those things when you look at it. And you may not get all the answers, but typically you get the financials, you look at them, you ask a few questions, you start the bonding process, then you go to LOI. Private equity stalls as much as they can. They will extract as much information before they get to LOI. They don't want to disappoint you and start off on the wrong foot, right?
That's exactly right. I never heard the term before. I like your term, and the way you put that is like you start trading trust and expectations as soon as it doesn't matter if it's non-binding. That's the legally non-binding,
Right,
but there's
exactly.
an expectation there, that's a really good way of putting it, and it's absolutely true. And I like your term retrading
Yeah.
because once you put it in the LOI, then you find out all this other stuff, and then you go back and be like, hey, we got to look at this, or either side, and the other party points to the LOI, but you said you were going to do this, and like, and let's be clear, there's some people that will do things on an LOI knowing perfectly well that they're going to get
Yes.
the seller down the path, and what do they call it? Send the owner to Tahiti. Like, yeah, we're gonna give you all this money and this, and then later
Yeah.
on when they're like, well, now that we got all this information, it's not going to be quite what we want. So
No,
do that
yeah,
up front.
yeah, these are red flags. So we're talking about red flags already, right? So there's
We
red
are.
flags for both sides. From a seller standpoint, if you've got the buyer not holding up and their bargain and lacking integrity, you should walk away. And we say this is my rule of thumb, and I got this from Adam Coffey, who's done billions of dollars of exits, and he's trained
Great
me in
name.
this. Yeah,
He's got a
I
great
know.
name.
He's got to be your brother, right? He's another brilliant man,
Right.
or a cousin or somebody. But anyway, this is what he says. If in diligence you find that EBITDA is 10%, that's just noise. you don't do anything. 20%, 30%, you're going to have to trade something. But again, I think it's how you do it, and you can do it through education. If it's over 30%, you got to say goodbye because you're just going to insult them. I had a client that, his EBITDA was destroyed in Diligence, and 40%, 45%, and she kept going back and trying, and everybody just got mad, and she wasted money and time and legal. You're in legal now, like, and you're paying people to Diligence. It's just not good.
Yeah. Let me
Yeah.
clarify that. Just because
Yes.
when you were saying that 45%, they made after Diligence, they decreased it by 45% of what was it?
Yeah. So she should have
Oh,
walked away, but she tried to go in and retrade for a higher earnout, for a higher, and at that point, I mean, this person had lost one of their rainmakers, didn't tell us. I mean, there's all this stuff going
mm,
on, and there was no malicious intent there. I don't believe there's a lot of malicious intent, but I do see fraud all the time. That is something I'm seeing again. I see that again and again. And as a seller, and I'm seeing it on the sell side, so they hire me. I always think financial statements tell a story, and you want to tell the best story to your buyer. You want to come disciplined with your numbers, with your all the other things that creates value. You need to come to that story. And what I'm finding is when we're putting the story together, things don't add up. Okay.
mm,
And then I'm like, all right. And in my past, I was a CPA for many years. I did do my time looking at fraud and then just growing companies. I had good internal controls. We still had fraud. Fraud enters where there's weakness. There's weakness everywhere. You cannot have perfect controls. So as a independent owner, we're not asking for that, but you got to be vigilant. So I've found in so many of my deals in the past 2 months, I don't onboard that many clients a month, but two. Okay. So
mm.
it's a lot. It's a lot. So since
Yeah.
I started doing this business, I'm seeing it a lot. So people need to be vigilant of that. Sellers need to be vigilant. It actually helps the buyer on the other side, but you don't want to go in to Diligence having theft in your numbers. You're actually losing money.
Right. Yeah, absolutely. I can tell you from my experience of operating for many years without a CFO, um, the difference. And we were doing pretty well. Then we hired a CFO, and I realized how much I didn't know. And it really prepared us well for the exit. Money well spent, helped me, run the process in due diligence. We were dealing with Deloitte, I think.
Yeah.
If someone from Deloitte is talking to me about accounting, 80% of it's going right here.
As it
So
should, as it
yeah,
should. Okay.
like that's
You don't
that's
need
not
that.
my area,
No,
right?
you don't need
And
it.
so
Right.
so
Yeah.
if
No,
you are thinking of
yeah. Yeah.
selling, like a CFO is like, I've been in this business for a long time. I didn't realize the value of a CFO until I had.
Yeah, I'm so happy you said that. They should pay for themselves. If they're not, you have the wrong one. And so let me give you another example. I mean, we're all over the place here, but let me give you another example that's really important for both buyers and sellers. So, and it's going to come back to CFOs. So, earnouts doesn't sound like it is, but earnouts you think are so simple. So, I had a client that private equity said, net revenue, that's what we wanted, but net revenue is net of bad debts, and they said based on historical gap, and I was like, oh no, oh no, gap is not black and white. Okay, you can
Uh,
get screwed here. Okay, the definition in earnouts will screw you as a seller, and it will make you crazy as a buyer. So those definitions are important. So what happened was, this is a great story. What happened is I painstakingly said bad debts are really, if we're still trying to collect it. I mean, me and the attorney, you got to have a great M&A attorney. Okay, somebody that does it full time
yeah.
or there too. And so we did a great definition, and the owner, he loves me. At the time, he's like, do we really need to worry about this? I said, yes, we do. And 4 months after private equity bought them, accounting went and changed all the practice and started writing everything off. And I'm like, well, their accounting is kind of right. Okay, they're being aggressive in their policy. So who knows this? Like, as founders, as CEOs, you're not meant to know this, but you got to have a good business partner with you to point out the problems before at the other end of it, you're not getting your earnout. And his earnout was like 20% of the purchase price. It was a big number, big
Yeah.
stakes. And I believe in earnouts that you have to be able to control that. And he could control the revenue, and then you don't wait till the last minute. So I said, get that email out there. Let's pull it out and say, yay, we support your accountants, but we want to make sure we're all in agreement that the earnout is based on the language in our EPA, the purchase agreement. And they said, yes, that's true. And now we're rounding the first year of the earnout. And they're like, yes, that's true. But we would have been screwed. So it's things that look simple business. So your CFO, your business partner, that you got to have somebody going through there with private equity. You had Deloitte. There's like 9 accountants and tax people and auditors in a room with just you. That is awful. You will lose. You will lose all day long. You will lose on working capital. You will lose on so many points. You don't go it alone. You will miss
Yeah.
millions.
Right. Even the working capital number, like
Oh,
coming to
yeah,
an
yeah,
agreement
yeah.
on that. Like
We could do a
and
whole
that is
episode on
something
that. Okay, we could.
totally. It was a
Yeah,
huge negotiation point. And to be
huge.
honest, before we started going down the path with this, I didn't even know I thought working capital is, do we have enough in the bank account to like operate for a
Yeah.
little bit? But the definition thereof and what it takes, and it's
I just
mutually exclusive.
Oh, yes. And I'm going to tell you, so the working capital really should not benefit either side. It should just be enough. And it gets obscured when bigger sales, everybody knows you got to deliver some. In the medium markets, small to medium markets, there's a bunch of fog that rolls in over this, just like you said, fog. And brokers help the fog because they say, oh, you're not going to get any, we're keeping our working capital, so they don't put it in the price. So I'm just going to give an APB out to the sellers. Before you put your price, you better think about what that working capital looks like, and you might have to deliver some, and you better do that and put that in your price, or you're going to miss millions. So we're missing millions here. And then buyers, you better figure out where they're at, because I see deals fall apart even after the LOI that the seller didn't understand. They're signing an LOI that says, we're going to give us 3 months of historical working capital, right? That nobody understands what that is. And I help buy a lot of accounting firms, and even the accountants can't agree on that number. So
Oh,
we could
okay.
probably do a whole episode on that.
Right.
Not that anybody wants to learn about working capital, but
I would say hire someone so that you don't have to
yes,
learn all this stuff. You just have to know who to hire to do it, because most guys and gals like me, we're only dealing with that working capital in an exit situation or an acquisition situation.
that's right.
So unless you're going to be doing that on your own a bunch of times, hire someone that's really good at it. But knowing about it ahead of time is really, really helpful, so that when you're looking at it, it makes a difference. Let me ask you this, as we kind of land the plane here, is what's one habit that you've seen? You work with a lot of people, a lot of sell side, a lot of buy side. What's one habit that you've seen a founder or a team do, or a focus area that really helps increase the enterprise value of a company?
Yeah, so I'm gonna put a shout out to your cousin Adam Coffey here. He's one.
Yeah.
He has 4 best-selling books out there, and I've worked with a lot of CEOs. I've done a lot of buying and selling, and he's worked with private equity, and he's never been fired from private equity, which is amazing. I mean, usually that's a big deal of a CEO not getting fired, and he gets hired by private equity. So what is different about him compared to everybody else? And that is, it's discipline. So let me explain what I mean by that. He's very disciplined about what the culture is like and how he creates a beautiful culture. He's disciplined about that. When he looks at acquisitions, he's disciplined about acquisitions. He doesn't shy away from walking away. So as a buyer, you need to have a buy box or a focus. And Usually you wait so long, it's hard to find them, and you look for so many people that by the time fish is on, you're going to reduce your standards. He never does that. He walks away with grace. And so in growing and scaling his businesses, which he has, he's grown them and sold them for $2.5 billion in every space of his empire. He empowered people. He gave them the tools. He gave them the accountability. He held everybody accountable, and I would say in a loving way. And he did that through the whole entire growth and then at exit as well. And so I think discipline is the most important thing. And it's the hardest thing to do is to be disciplined. So
Yeah.
yeah.
Yeah. Separate the emotions, stick to your guns on
Yes.
what your parameters are, make sure it fits in the box. And if nothing is fitting in the box, maybe you need to go back to the drawing board and see if you need to change it, but don't change it midstream for a deal.
Yeah.
Right.
That's right.
Yeah.
Mm-hmm. Yeah.
Interesting. What do you think in all the, this is the final question,
Okay.
is what do you think the most expensive mistake entrepreneurs make, either in the buying? No, let's do it one or the other because it's so
Okay.
vastly different.
Yeah. Yeah.
And when someone is selling, let's do that because most of the people that are listening are growing their businesses and there's going to be an exit. What's the most expensive mistake someone could make?
That's easy. Most people don't prepare to sell. You have to prepare. And guys, listen, I'm begging you, prepare to sell before you need to sell because it's going to make your business more valuable. And that's actually beneficial to you and your family as well. And so the biggest mistake is not preparing. So what do I mean by that quickly is I think you have to think about clean financial statements. You have to look at EBITDA and normalized EBITDA, not your country club dues. We don't want to see all that. Just piece that out. That's a normal thing, and see what you're really earning and be honest about it. And then get professionals who've done it before. If you're only selling once or twice, like you can't see it all. So bring somebody in so they can tell you, set your price with that working capital in it. Be careful about earnouts. You have somebody with you. That's the most expensive mistake there. And on the buyer side, we sort of already talked about it. I'll add one more thing to it. So the buyers rushing to LOI, don't do that. Okay, just don't do that. And then buyers that don't start integration until closing, that's a mess. You're going to leak value. We're buying humans, we're buying processes, we're buying things that need to be backed up to the very first conversation you had with that seller. You should be thinking, how do I mitigate the risk? What does my ops manager have to do? Who are the key players that I need to lock down, okay, in this agreement? There's so much integration that's happening. What do their benefits look like compared to our benefits? And there's so much to lock down that you will leak value. Important humans that work for you will walk out the door. They will be demoralized. So I actually say for buyers, like, you honor that entity, that company by coming in at closing, do a pitch deck, buy them some treats, tell them they matter, okay? If you can talk to all of them, talk to all of them. At least talk to the key leaders, open it up without the seller there, open it up, see what's going on. I have found more issues that way than anything. Make them feel like they're part of it. Get them excited about your mission and your vision. So that's where everybody's missing the millions, leaking the value on both sides.
Okay. Right. I spent some time with a gentleman that owns hundreds of QSR places, and some of them he buys them, 6, 7, 18 at a time. And I asked him what his process is, and he's a very affable person and wicked smart, obviously. And he goes, "Oh, we have a whole thing for it. Like, I fly in, we go in, I have my key person with me. I go up there, I have everything. Like, this is what's going to change. This is what's not going to change. And I know this is really scary." And then he goes, "And then I just stand up there and I answer every question they have."
That is beautiful. That is the playbook everybody must use. And you have to put yourself in their shoes. So what are they worried about? What are they scared? Do I have a job? I mean, it's just basic stuff, benefits. And then you try,
Yeah.
like, I always try to be the superhero and like add something in, like, oh, we're offering pet insurance, or I don't know. I just made that up, but because my dog barked, but I don't
Not
know.
a bad idea.
Add something in that kind of makes you cool. And,
Yeah.
but that's a beautiful playbook. Yeah. Thanks for sharing that. That's great. Yeah.
Yeah.
Perfect.
I like your pet insurance idea too. I'll
I
have to
don't
bring
know.
that up to them.
I mean, you never know. People have
Yeah.
pets. Like if you're in Seattle, that's great. People want pet insurance.
Well, yeah.
Yeah.
I think, there's a lot of fur babies out there right now.
There are. They're very
right?
popular.
Yes. Well, thank you so much for spending the time and sharing your knowledge. And then we'll have everything so that if people want to reach out to you, they can and get some questions answered and hopefully build a relationship. And I'm sure just the general information that you've shared today is super helpful to somebody that's listening, hopefully more than one person. But even if one person got this, what you've done today is a huge benefit to entrepreneurship and small business and business in the US. So thank you very much.
Thank you. And thank you for all that you do for everyone. Thank you.
That's my pleasure. Take care.
That wraps up today's episode of the Franchise Scale Up Show. If this gave you a strategy you can put into play, please share it with one founder who needs the help. You might save them months of pain. If you're ready to go deeper, whether it's building your support infrastructure, accelerating territory sales, or preparing for private equity, go to guycoffee.com. That's GUYCOFFEY, and book a free franchise growth strategy call. I only partner with founders who are committed to scaling without losing control. If that's you, I'd love to connect. Until next time, protect your vision, move fast, and scale smart. I'm Guy Coffee. Talk soon.